You either have years of not hitting all-time highs or years of hitting all-time highs.
Yes, and we have a bunch of years of hitting all-time highs. Streaks are why momentum investing works.
There it is. We'd shut the show down right there, I think.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Why are you repping today? Huh? Why are you repping today?
I'm always repping, Douglas. I am always repping.
Every day I'm repping.
You don't like my perplexity swag? You really don't like it?
I feel like you're converting, and I don't know from what or to what, but the Perplexity AI shirt is step 4 in some process that I need to know about.
It's really good. You don't use it?
Every now and again, it's not as good for me so far, and the things I've looked for, it's not as good as what I thought it would be. Like,
Yeah.
because what I do, here's what I do. Here's what ends up happening. I go to the Google machine, I type in something, I'm like, no. Then I go to ChatGPT, type that in, and I'm like, okay, but let me check Perplexity, because Perplexity is supposed to be the place that when I want facts, like when I want to really know what's going on, I go to, and I go there, and I'm like, it's like, So nothing yet has compelled me. This is not about Perplexity. It's about
No,
my search capabilities.
your process is wrong. Just go to Perplexity and then you're done. And that doesn't mean you always get the perfect answer, but it's better than Google. It's better than ChatGPT. It's easy.
It just hasn't given me that answer yet that makes me say this is where I go to first. That's all. That's it.
No,
But once that happens,
all it is, hold on. All it is Google. It's Google. It reads the first 10 articles and then it summarizes them and gives you source references. That's handy for me. But I don't know why you're trying to turn this into an ad. This was not on my agenda first, but we're going to go there.
hold on. No. Hold on. I don't know why you're trying to turn this into an ad. That's what you said. You're the one that showed up in a sweatshirt.
You're wearing a basketball t-shirt right now. I didn't choose
That's
to
right.
talk about it.
I'll talk about the Nugs all day.
All right.
All right.
This week I was reminded, this is not the first thing to talk about, but I was reminded of how many horrible podcasts there are. Now, I'm not going to go list by list, name by name, but occasionally, let me take you behind the scenes on the show. Occasionally, someone comes to us and says, oh, please, great Skippy and Doogles, let us on your podcast. Here are my credentials. Look at all the other podcasts I've got to. And it is 99.9% of the time complete hogwash. Someone who has no clue what they're doing, who we would never give a microphone to broadcast their nonsense. But my goodness, you can look at some of these. I decided I'm not going to throw shade. I'm not going to name each individual podcast, but I could probably be talked into it. There are so many sham podcasts out there, Douglas, that will take anyone at any time, act like they're an expert, and peddle it as investment advice. Why?
It's an easy thing to do. Because I was like, here's the thing. I always got confused at how many people write books. Because a book is a hard thing to do. You got to write it, which is tough. Maybe not for everybody, but I think most people, writing is hard. Good writing is hard. You got to get it published. There's a whole thing behind it. I'm like, so then how are there so many bad books if it's so much work? Podcasts, to create one is easy. So if you say that this many people will walk over broken glass to get a book out, Riff Raff McGrath will come out the woodwork.
Yeah.
When you know I know, what I'm saying?
But I just don't like.
And somebody,
to use your book example, I want to have someone knock on my door and be like, "Hey, I hear you're writing a book. Can I be the featured expert in chapter 12?"
That is
sure that's happening, but
okay,
oh my
true.
Goodness,
touche, mon frère. Touche.
Switching gears from that. So if I say the 3 letters TGL, do you know what that stands for?
Toogles.
You did
Tiger
not
Global?
watch the
Tiger Global? Something?
You did not watch the Tiger Woods Rory McIlroy indoor golf league that premiered Tuesday. Have you even heard of the thing? This is what I expected from you.
Golf? Yeah. Is this really what you're okay? Go ahead.
Indoor golf with a dynamic green.
Mini
it's
golf.
Like this massive simulator with 2,000 spectators. looked fantastic from my perspective. Here's how it relates to investing. I watched the thing. I went, I'm buying some of this new professional sports league. It's done. I was
Wait,
using my perplexity search.
You're an owner?
Obviously.
You're an owner?
I'm trying to.
Okay.
And I very quickly realized I don't have the funds to match Tiger Woods and Rory McIlroy.
Ugh, but close.
Or Kevin Durant and the rest of the super rich people that are backing this thing.
But you're a part owner of the Knicks. Am I correct?
That's right. That's right.
So you could probably, if you just throw that weight around, you can probably get your way in there.
I think if James Dolan ever sells, I can just cash that check and I should be able to buy all of TGL.
Yeah, there you go. That's right. That's right.
All right. That's all my hogwash. With the exception of one thing, our thoughts and prayers are with all the folks in LA County. Horrible stuff. We had it happen in Colorado a couple years back, and we can feel your pain. So hang in there. Hopefully, if you're in that region, listening to this hogwash will give you a smile, good distraction from all the devastation happening now.
It is awful. And so this is obviously separate from investing. I just read this book called Fire Weather, which it looks into how fires work using one big fire that was up in Canada as like the core of the story. It's mostly about how climate change is also contributing to the beast that is fire in general. But so I read this and finished it like a week ago. And so while I'm not in LA, so I don't feel directly like the pain, right, that's coming from this or experiences coming from it. Do know people in LA and it's awful there. But the way that I'm seeing this fire is so different. After having read this book, it is frightening. And I know you in your neighborhood, went through that a couple of years ago. It's like, yes, thank you for shouting that out. It's very important. Okay. Transition.
Let's do it.
Transition. So I got this question this week about interest rates. I'm going to read the question, but I want to take it in a couple different directions because this is something that comes my way frequently, some version of this, because it's a complex adaptive system, the economy, and that it's confusing, just put it short. So I'm going to throw this out there. I just don't follow the jobs up, economy strong, delaying rate cuts linear process. Is it that lots of jobs, good economy means people can afford higher costs of borrowing versus lower cost of borrowing and more surplus cash to spend, so too much demand, too little supply keeps inflation high? What's up with the Fed not cutting? So in short, why does a stronger economy mean the Fed's likely to either delay rate cuts or not cut as much or not cut at all? That's like the short version of this. I want to take it in a couple different directions. So one is the direct piece of the relationship between what's happening in the economy and what the Fed does or does not do. The second is the impact on psychological impact that people have on how do rate cuts impact stock performance in theory. Those are the two things I'd like to touch on.
We are not going to peddle. This is all complex stuff. We're going to explain the basic logic here, but I will say that the basic logic is sometimes fundamentally wrong. And
yeah.
And anyone that's followed the stock market for 20 plus years knows that sometimes you think X is going to happen and that means Y will happen. And then X happens and the exact opposite of Y happens. So
that's right.
A lot of this is just fools behaving irrationally when it comes to like your daily moves of the stock market. But yeah, let's break it down.
That's right. Okay. So on the first one, relationship between Fed decision and the economy. And again, I'm going to second what you just said. This is all kind of like the high level view, the academic view of it.
Yes.
And practically, sometimes it plays out differently. But here's a relationship. We'll start from the opposite side. A reason that the Fed will raise or lower interest rates is to boost or lower consumption and investment in the economy. And the way that works is if you lower rates, that means businesses have more access to capital, they're more likely to spend. And so if the Fed says we need people to go out there and spend money because we need the economy to get strong, they will lower interest rates. Again, that's the simple academic view. If they want the opposite, if they go, ooh, economy too hot and bothered, so we got to slow it down, they will keep interest rates the same or raise interest rates. I'm going to pause, react.
I'm going to say something similar, but in a different way. So, because it might hit home differently. If we go back a couple of weeks ago when we talked about Howard Marks' simplistic view of investing, saying you have two choices: debt or a piece of ownership in a company. So for a second, let's talk about debt as U.S. government debt. You have some excess cash. You have two easy places to put that excess cash. You can either put it in U.S. government debt or company ownership. If interest rates are really, really high, people often call U.S. government debt basically risk-free. It's thought of as like the risk-free rate when you talk about an interest rate, because historically, this may be slightly different than today, but historically, the U.S. government had basically zero chance of going bankrupt. So that debt was thought to be basically as good as anything you could buy in the world.
Yep.
So I'll go to an extreme example of the 80s when that risk-free rate is like between 14 and 18% at its peak. Just think about where your money goes in that scenario. Your money goes to buy U.S. government debt because the large majority of people are going to be super happy with an 18% return on their money that's basically risk-free. That means that almost no one buys equities because the trade-offs just don't make sense. Today you're buying equities being like, oh, I hope my Google stock returns 18% a year for the next 3 years. That'd be amazing. If you could do that with no risk of basically no downside, you go that way. So that's how I think about it. The simplest sense, what you're saying about trying to feel the economy is totally right. But just think of it's just that they're messing with interest rates just to make money move to different places of the market. And when money moves to different places of the market, that has ramifications for what investments are made.
You're blurring lines here. What you said was accurate.
Yeah.
But you're blurring lines here. So the Fed, when the way that the Fed is supposed to be working is they do not have stock markets in mind. That's the way they're supposed to be working. That's the way they're supposed to be working.
I agree.
Okay. But why I said you're blurring lines is because like you're sitting right in the middle of the way that the investors are thinking, how markets move, and the Fed decisions. I was trying to separate them for simplicity, but you're right. The way it actually works is not completely separate. You're absolutely right. But I'm gonna use that for the transition. Okay, so you got the Fed saying we either want more money to be spent, less money to be spent. So we either make money more free or less free so that people spend or not. That's the first part. On the second side, how does this impact the stock market? I'm going to start with what you just said. Tina, remember our girl Tina when we were talking about Tina a few years ago? She's strutting her stuff, them hips moving left and right. The thing about Tina, which is, what is Tina? I just forget. Now I
There is no
Tina.
alternative.
Yeah, there is no alternative. Yeah. So the thing about Tina is when we were talking about this before, is because like where are you going to put your money, and you're making decisions on where to put your money. And sometimes it feels like there's no alternative to stocks, so you put money there. But what you were just laying out was a great alternative. If you have a great alternative to stocks because you're making 18% on something that's risk-free, you're likely going to put it there, not in the stock market. Stock prices can go down. Another thing is, this is probably the most complicated. If you see that the valuation of a stock or the market is the current value, present value as that's known, of future cash flows, then what people do, I shouldn't say people, what the most sophisticated models say that they do is they take all future cash flows and they discount those back based on some rate to get to the current present value. And that discount rate, the higher it is, the lower the present value. The lower it is, the higher the present value. Just imagine that rate as interest rates.
You're totally right. I was going to say something similar, but that's your average person doesn't even need to know those terms. Your average person has a pool of money. They want to figure out where to put it. There's probably the two options I talked about before and a savings account. And they pick one of those three buckets. They do the same with a home purchase and everything else, and that's based on interest rates. But they pick the bucket that makes the most sense to them. And when the reason you mentioned Tina, there is no alternative, is because in the zero interest rate world that we have come out of, there was really no reason to sit on cash and almost no reason to buy bonds because you got like no return. You were guaranteed no return. So that's why the everything bubble, as it's talked about years ago, was simply people going, yeah, I have some money. Doesn't make sense to have it in a savings account.
Yep.
I think I'll buy some crypto because I don't know that maybe I can make 10% on my money there.
That's right. That's right. And there are other reasons too. So I thought it was helpful. I thought it'd be helpful for us to just talk through the interest rate stuff. Hopefully it didn't make it more confusing than what it was before. Can I give what I think is the simplest view, and then you can tell me it's actually not.
Please. And then let's talk about this past week too, because I think the question came from like Thursday, Friday this past week.
That's absolutely right. Okay. So the simplest view is if you want people consume more, give them freer money, lower rates, give them freer money, consumption goes up.
Yes. And we've built our economy on consumption. So rates have been historically low for the past 20 to 30 years as when compared to hundreds and hundreds of years of historical data.
If that money is free, there can be more investment and more ability for profit generation for companies, therefore buy stocks. And you have no alternative to get a higher rate of return. There's so much complexity to add on to that, but can we just leave it there and talk about this week?
Yeah. So here's I think
happened
this week, but I don't follow the day by day closely. So correct me if I'm wrong. It was like Thursday that the jobs report came out, and
Friday.
It came out.
It's always Friday.
It was Friday. Okay. The jobs report came out way better than was expected. And what seemed to happen in the investor psyche is, oh no, that means the economy is actually stronger than we expected, which means when the Fed looks at the strength of the economy, they will not cut rates. And that caused stocks to drop 1.5% or 2% on average. Is that correct?
Something like that. Yep. That's exactly right.
This is really like your hyenas in the streets. Like, no, the people that sold their stocks based on a job report and two other speculative guesses are idiots, but that's how the stock market works.
Yeah, and this is why it's confusing. The primary reason I think why it's confusing is because if I came to you, let's just take an individual company and then I'll aggregate out to the economy. If I came to you and I said, I got this company, it is chugging along so strong. Like you cannot believe how well this company is performing. Do you want to invest? You couldn't give a yes or no strictly on that, but you'd probably be like, tell me more. And we're saying, woo, the US economy is like, we're getting after it, baby. Go, baby, go, baby, go. Do you want to invest? And people went, no, I'm good.
Yeah. Your company is worth 2% less than it was yesterday.
Yeah. Like that's confusing. That's at its core, you would say if things are going strong, go long. That was just a little rhyme I came up with. But if things are going really strong, then we should invest more. People should be buying stocks because the U.S. bet on America. And that's not what happened that one day.
It tells you how stupid things got in the last 5 years.
Yeah.
We took interest rates to zero, we created the everything bubble, and then we wrote everyone checks. So they were sitting on more cash to buy NFTs. Remember when we were talking about NFTs?
Yes.
JPEGs that are somehow worth money? Like, so then there's nothing to buy. There's no reason to hold it in a savings account. People are sitting on extra cash. They spend money because that's what humans do. At our core, we're hunter-gatherers who, if we have a pile of berries over here, we try and eat the berries because they're gonna go bad and we're hungry. And then we get to a place where the current Fed rate is what, in the 4% range, and people think that's outrageously high. Like that's tiny. Unemployment is 4% as well.
We've gotten used to something that isn't real. Low, pretty much zero interest rates is not real. We've gotten used to it.
I personally hope, and I hope this never comes across wrong, because I know that fluctuations in the stock market do have ramifications for certain types of people, but I loved Friday. I hope we get 20 more of them. I would love for some of the quality companies that I want to buy to go down another 50%. It'd be the most amazing thing on earth. And I would buy those companies hand over fist, and I would dance for the next 50 years. It'd be so great.
I feel like these are movies that came out in the 70s where they would have a high school dance and it was the last person standing somehow wins an award. Is that you dancing for 50 years?
I would.
You would do it. Okay. All right.
If the right companies, yeah. Yep, I would.
Okay, next fishbowl item. And this hits on part of what you were talking about with the idea of don't say always, don't say never, The market does not react in the same way for the same bit of information, for the same set of circumstances. It's a complex adaptive system, which you always say. Charlie Bilello, Charlie's charts. Charlie's charts is like a thing of beauty, I think, all the time. It's always like useful to go to Charlie's charts. So every year in December, or for the last at least couple of years that I know of, in December, Charlie Bilello comes out with a post in December that's charts you should put on the wall. And it's just a blog post full of charts. That's what it is. The charts that came out this last December, there were lots and lots of them. I want to highlight a few. If there are any that stand out to you, you should highlight those too. But to give an example of the types of charts that we're talking about, are there things like all-time highs are a sell signal. And then he'll show a chart that says the opposite. So it's basically like, this is the thing that the market says. Let's look at a chart. So I'll give you a few and just take these as him saying this is what people say, but the chart's going to say the opposite. All-time highs are a sell signal. Investment returns are linear. It's oversold, overbought, and can't possibly go any lower or higher. Okay, so that's an example of some of the charts. Here's one that I knew would tickle your fancy. Emerging markets can't possibly underperform any longer. He shows this chart, which you've referred to something like this before.
Mhm.
He shows this chart going back about 30 years that shows the underperformance, overperformance of emerging markets versus US stocks and the ebb and flow that's happening. The reason he goes back into that period is because we are right now at a record low relative emerging markets performance relative to the US market. The last low was around the turn of the century, 1999, 2000. And saying every time that we go, they can't possibly underperform longer. Throw your cash in. He goes, well, they could. Like they could continue to underperform. At some point, they're likely to turn, mean reversion, but you don't know when that point could be. So that's the first. I thought you might appreciate that one.
I mean, we mention it all the time. The last time this happened, emerging markets outperformed for the next 11 years. So
Do what you will with that.
we'll see. We'll see what happens.
Mm-hmm. This one surprised me. Inflation will never come back down. And the chart that he uses for this is the Argentinian monthly inflation rate. He goes back to December 2023. Argentina's inflation rate was 25.5%. It's now at 2.4%. In about a year, it went from 25 to 2. That is
Right.
that is wild.
And it had been north
Absolutely.
of 10 for years and years and years. I mean,
Yeah.
it's a brave new era.
They went from absolute debt ridden in the country to a budget surplus.
Mm-hmm.
Or sorry, I should say absolute budget deficit to budget surplus.
Yes. Yeah. I like the graph on the price of a used Tesla. Now, there's a lot going on because there's more Teslas available. And when this graph started, basically there was such scarcity because there were so few models. And there weren't many models that were 10 years old because it's a new
Yeah.
car brand. But still, it went from averaging around 50K, peaked again during the everything bubble. Imagine that at almost $68,000. And now it's like 30,000 and continuing to drop. I expect this to continue in electric cars. I expect electric cars to follow a price trend similar to televisions. I know that's an extreme view, but it's
Yeah. You've been saying that for a couple of years. And what I'll say is we don't know what the future's going to hold. But during the couple of years you've been saying it, the trend is exactly as you've been stating. So
oh,
the
and the
trend is
new stuff
promising.
they'll like give away on leases because next year's model is so much better that the previous year's
Yeah.
model just doesn't hold its price, and that continues to happen. And I expect that, we'll see that trend for a while.
If we get to the point where it's similar to hardware, software in the computer industry,
Mhm.
where it's really the car is the software, which is a lot of where Tesla has been pushing. That's fascinating. It's scary as well for a number of reasons, but fascinating.
Yeah, I think get used to it. The other thing, just since I've mentioned the everything bubble so much from our kind of listener mail here, is he has the watch chart Rolex market index. Guess when it peaks? Oh, late 2022. I'm shocked. Yay.
Yeah, there we go. Yeah. All right, the next one. This streak can't go on any longer. And it's a table that goes from 1900 to 2024. And for each year shows the number of days that the stock market closed at an all-time high. The summary I'd give is we are just a market of streaks. That's the summary I'd give. It's not that the streak can't go on any longer. All streaks do is go on longer. You either have years of not hitting all-time highs or years of hitting all-time highs.
Yes, and we have a bunch of years of hitting all-time highs. Streaks are why momentum investing works.
There it is. We'd shut the show down right there, I think. All right, the last one I pulled out here. I've never actually heard someone say this, but I like the chart a lot. Putting money under your mattress is an effective strategy to combat inflation. I've never heard anybody say that, but I imagine Charlie has. But the chart I like. So what this chart shows is going back the past 30 years, so to the mid 90s. What has happened to the purchasing power of the US dollar because of inflation? It has dropped in half. So inflation has doubled prices overall. Is the way to think about that.
Yeah.
S&P 500, inflation adjusted total return is up 1,000%. The point of this is saying, if you have the choice of putting your money under your mattress or investing it in the stock market for the last 30 years, it would have been better to have put it in the stock market.
Okay, why you do this to me, Doogles? This is a extremely misunderstood concept. Over the long term, not investing in the stock market is riskier than holding cash because inflation happens. So your purchasing power erodes. You have to be invested in something that grows faster than inflation.
Yes.
The problem I have with this is like the Bitcoin crowd will only show the dollar purchasing power aspect of this chart as if there's no alternative to all you're allowed to do if you have $1 million is put it under your mattress and look at how that value erodes poorly over 100 years. Like that's the only chart they show. They don't show that all you have to do is have a reasonable investment strategy of that $1 million and you're up 1,000+% outperforming everything, including inflation. So this chart gets abused massively because people don't seem to understand inflation.
I'll give you that.
Can you say that more precisely for me?
No. I'll give you that. I won't know what to say if in 15 years the Bitcoin chart looks similar to what it's looked like so far. I will not know what to do with myself.
It can't. I don't have a spreadsheet in front of me, but this is where anyone that makes that projection doesn't actually do the math, because that would lead to something like I'm making up numbers to be crystal clear here. $500 trillion market cap, like more money than is in the entire economic system of the world. But people will say, well, just look at historical performance. No one ever does the math.
Bring it. $500 trillion market cap. Bring it, Kathy. That's a Kathy Wood reference, by the way. All right, what you got next? I got one more thing in the fishbowl. What you got?
I think we should go to your thing. I'm curious if you have strong opinions on New York's congestion pricing.
I want to watch it. We talked about this, I can't remember when, some odd months ago, how New York was going to start having tolling for being able to drive in Manhattan. And it started. It's kicked off. And I'm like, so far, it looks like people are driving less, which makes sense. It just kicked off. There was also reference to the fact that London did this. And there was basically a short window where it started working. And then people understand how to systems adapt to themselves. Maybe I should say it that way. And then London ended up, I can't remember why it is, but London ended up getting the same amount of traffic.
Let me give a high level overview for those who haven't heard it, because I thought this breakdown was nice. Basically, south of 60th Street in Manhattan, there's a $9 fee for passenger vehicles from 5 a.m. to 9 p.m. on weekdays and 9 a.m. to 9 p.m. on weekends. There's a $14.40 toll for smaller trucks, a $21 toll for larger trucks, a $4.50 toll for motorcyclists, and a surcharge for taxis. Really, the reason I wanted to talk to you about it is because I don't have strong feelings either way. But I do think it's fun to watch in real time, just supply and demand happen.
There's no strong feeling, but I think it's interesting. I think it's an interesting point. We'll see what happens with supply and demand. I still just say there's some chance this seems like it could work.
Really strong take there, Doogles. Excellent work.
Yeah, I'm going to repeat it just so it sits in people's heads. This could either work or not work. Only time will tell.
Yeah, what else is in your fishbowl?
The last thing, we bring this up at least twice a year, but probably closer to 3 to 4 times. Howard Marks has got a memo, people, called On Bubble Watch. Now, your take on this when you sent it over to me is different than the take I had when I read it.
Okay.
Because what you said when you sent it over was Howard is basically saying we're in a bubble.
Mm-hmm. Well, Howard's smart. He never makes absolute statements because he's actually been an investor for 50 plus years.
What Howard says is it's a little bubbly, but there's also signs that this bubble doesn't look as obviously bubble as the last couple.
That's come on now. You got to read between the lines. No, he's smart enough not to be
lines. I read the lines. I read the lines.
Yeah, okay. The first paragraph says 25 years ago today, I wrote that we were in a massive bubble and things exploded 6 months later. That's not that foreshadowing didn't do it for you, Doogles. You couldn't read between the lines and say,
nope. Here's what he ends it. You talk about the start. I'm talking about the ending, baby. If you're talking about the Breakfast Club, do you talk about the start or the ending? You talk about the ending with Judd Nelson with his fist up in the air. That's what you talk about. Okay. If y'all have not seen the Breakfast Club, go watch that right now.
No one has not seen the Breakfast Club. What's wrong with you this morning? Come on.
Just saying, you talking about beginnings on endings, so you must not have seen it. At the end of this, he says, here are some things that are a little different. The PE ratio on the S&P 500 is high, but not insane. The Magnificent Seven are incredible companies, so their high PE ratios could be warranted. He doesn't hear people saying there's no price too high. And the markets, while priced and perhaps frothy, don't seem nutty. The short version is, so he goes into the Nifty 50, which is the 1970s, bubbly stocks. And he says there, the PE ratios were 90, 60, 70, 80, 90. He goes, you look at NVIDIA, PE ratio's high. It's in the 30s, but it's not 90. And they are spitting out buku wuku profitos. And so the thing where he says that you have to believe that is not a thing that you have to believe that is not historically justified is that you have to believe, if we just take the case of NVIDIA, that NVIDIA will persist in its profiteering over time, that it will persist even as a big company for decades to come. And if you look at the makeup of the S&P 500 20 years ago, look at it today, persistence is not the rule, it's the exception. So he does say the companies justify more than they have historically their values. He's not saying they're justified, but he says more than they have historically. However, what you have to believe for that justification, history has not shown to be true.
I'm really disappointed in you. And it's more fun to take it out on you than anyone else. You're just not reading between the lines properly. Howard knows that he has to write another memo in 6 months, and it's very possible that nothing happens in the next 6 months except things get more expensive. He's just smart enough to never make an absolute stance.
Okay, so you're reading between the lines. You obviously didn't read the lines themselves.
So true.
Let me tell you something else. I like this one. So he shows this graph, and we have talked about versions of this graph many times before. That's showing the projection of 10-year annualized returns and current level of PE.
Mm-hmm.
So it basically is a quite linear trend. The higher the PE ratio, the lower historically the next 10 years of returns. Right now, we are near the high end of that. And it shows, I'm going to quote it. So the chart that he shows goes from, 1998, I think something like that. It's 27 years. And he says, and it's monthly, it's from JP Morgan. It's month by month if you look out 10 years. He said, in that 27-year period, when people bought the S&P at PE ratios in line with today's multiple of 22, they always earned 10-year returns between +2 and -2, 100% of the time.
Yes.
That does not mean that it'll happen in the future, just, for a little disclaimer. But he's saying, it's never not done that. So if you believe that it's going to do something that's not that, you're in this time is different camp in some kind of a variety. And he goes, next thing he says is some people might go, okay, all right, so for the next 10 years, I got to ride this -2 to 2% range. That's okay. I can do that. I can do that for 10 years.
But you have to do it with volatility and panic.
That's what he's saying. That's what he's saying. He's saying You're not for 10 years going to get a -2 to 2%. What you're likely going to get is a 2 to 3 year down 40, 50%. That's what you're going to get. And can you ride that ski slope?
Wait, that's what he's saying, and you can't read between the lines and say you just said he's saying a 2 to 3 year 30-40% drop. And I'm just saying, read between the lines, Doogles, and call it what it is. He's not making absolutes, but he's the title of this thing is called On Bubble Watch. How much more he's watching? He's not calling for it. It won't happen tomorrow. It's called On Bubble Watch.
Was Baywatch even in a bay?
No, definitely not.
Yeah. So exactly. So Bubble Watch.
That is a great retort. You win the argument. Applause.
No, you're right. He's saying there are reasons here. This is not what he's saying. But if I'm reading between the lines, I'm gonna try and read between the lines with you. The way I would interpret this is there are reasons to see this as not a bubble or different because it has markers that are different than the last couple bubbles.
Mm-hmm.
And you should look pretty closely at those reasons and what you have to believe to say we're not in a bubble and compare that to history. And your what I have to believe test is likely to fail.
I mean, we can put a bow on this, but one of the things I like about the memo is it goes through the fact that there's similarities between the last few bubbles, but the only thing that can cause a bubble is some new technology. Something's different. Like,
yep.
It's never going to be an exact repeat of the last concern, whether that's mortgage-backed securities with housing or whatever else. Right now, there's all this optimism around AI that allows people to say, I'm wearing a Perplexity sweatshirt over here. I mean, and I'm a value investor, Doogles. So
we've covered
that tells you all you need to know.
We've covered
right?
that, yeah. Yep.
Have we? Okay, good. But it's different for sure. There's enthusiasm around a new thing. That's exciting. Everyone's excited about that.
I do love that point. And he says something along the lines of, it's not that the bets are wrong. It's just that they take it too far.
Yeah, completely.
I think it's pretty straightforward. All these, including the Howard Marks piece, will be on the Substack, skippydoogles.substack.com next week. So you can check out the whole piece. And you decide what's between the lines, what's on the lines, what's below the lines, what's above the lines, or what's in the lines.
All right. I think that's a wrap. If you missed our annual review show where we did stock picks, that's available to the most premium subscribers. We just recorded last week, so it's fairly fresh data there. Listener mail is skippydoogles@gmail.com, and we'll see you next week.
Thank you, everybody.